What's going on, guys? Welcome back to the channel. Today we're going to be analyzing a bunch of companies. I would like to call this Speedrun Stock Sunday. Hopefully just the first episode today, and hopefully we're going to have more of these because I find them to be kind of fun. But anyway, I'm going to be going over as many stocks as I possibly can. Now, first thing that I want to analyze is a company called Blue Links Holdings. Now, if you would like to get this platform, it's free at this link. I'll make sure to leave it in the description. And yeah, we're just going to be analyzing this company. So I actually do have this company in my watch list. However, there is a major flaw with this company. It's just the simple fact that they're in the house building industry, and they just make wood as their primary thing. However, as the housing crisis appears, they will probably lose some of their profits. And another problem that it faces is that their margins are very low. You can see that their margins are like 3% into the future, and right now they're like 6-7, which is great. You can even see right here. But anyway, so they're like 6-7%, not too bad margins. But you can see that even the forecast is really bad. And this is amazing. So their PE ratio is 5, and their price to sales ratio is actually 0.2. So that's insane. And plus the book value is actually almost bigger than the market cap. This means that the total amount of assets minus their liabilities are about the same as the cost of the company. So technically, if you bought the entire company and paid off all of its debts and sold everything they had, you'd pretty much nearly make a profit. Now that's amazing. Now they aren't really doing anything with their shares, which is not too bad. They have recently bought back 1 million, but it's nothing too crazy. And then their debt is not terrible, so pretty good situation there, and their assets are just amazing. Yeah, even their returns on every single one of their returns is just amazing. Like in 2020, they had a huge return on equity. So that's Blue Links. The major flaw of this company is just that it's in the housing crisis. That's just a really bad thing. But I would be eager to buy this company at lower prices because right now, even though the PE is like 5, if their earnings drop by 3, the PE is going to be 15, and it's just the uncertainty. So maybe next year when this happens and the stock actually drops, maybe then it will be a good buy. Now, the second stock I want to go over is actually a stock that I've already analyzed on this channel, Canadian National Railways. Now, this company is just amazing. I just love this company because, look at this, it's just incredibly stable even into the future, and their margins are great. The growth forecast is amazing. So yeah. And then you can see that their debt situation is pretty good for a company like this. They can pretty much pay it off in like 3 years. Their shares outstanding are going down. Yeah, the valuation isn't too bad. Like you can see that the P ratio right now is 13. It's not too bad. That's in percentage. I have to change that. That's a bug. Now their assets and liabilities are not terrible. They can pay off all their liabilities with their assets. That's great. Their returns are pretty decent, right? Even their return on assets is 10%, which is amazing. They do pay a small dividend, but not too big, so nothing crazy. Definitely a very stable company and a great choice for very conservative portfolios, because this isn't really going anywhere. Now, the next stock I want to go over is Cognizant Technologies. Now, this is a little bit of a bigger company, as well as CNI. The market cap is 30 billion, and these guys have a PE of 15. Pretty high, however, their growth is just great, and their margins are amazing as well. Well, not amazing, but they're pretty good. At like 12% right here. Even the forecast is great. And one thing that I do love about this company is that the earnings and free cash flow are very similar, which instantly puts me into less of a fraud detection kind of state, because when a company's earnings and free cash flow are very different, I just instantly kind of just think about what might be wrong about the company. So that's a thing. Now they have been buying back some shares, and they also do pay a small dividend. Just like the small company, just like the other company, their payout ratio is great for what they do, for what they pay, and they have no debt, and their returns are also pretty decent. Now, the assets and liabilities right here are also just amazing, because if you think about it, their market capitalization, or the cost of the company, is 30 billion, right? And all their assets minus liabilities is like half of that. It might be like 15. So there's 8 there and 4 there, so it's like 12. So they can just pay off all their assets, and yeah, it's just amazing. So this company definitely does not have any cash problems. However, let's actually value this company, because I'm actually really I want to know if it's a good chance to buy this company right now, because I'm pretty interested. So let's just go with some numbers here. I think the growth rate won't be too high for the next couple of years. However, I'll just go with 3, 5, and 7. I'm gonna go with the same profit and free cash flow margin. The P is okay, and the price to free cash flow, and you can see that it's actually really expensive. But it's funny, because the entire market is really expensive right now. But anyway, one of my favorite companies now, Malibu Boats. I've been looking at this company for a long time. There's also a analysis on my channel, and this is a very small company with great valuation metrics. So the price to earnings and the price to free cash flow are really low. They are increasing the shares. Well, not in the last like 5 years, but they have been increasing them in the past. So that's something to take into consideration. However, they have no debt. You can see that they. I don't think that the 2020 metric is here yet. It's probably a glitch, but the debt right here, you can see that they can just pay it off in 1 year. Now their assets are great. So you can see that the market capitalization with this one is 1 billion. And their book value is just over 616 million. Now, the market capitalization here is different from the market capitalization here, because this one is the current one, and this one is the for the closing year of 2020. Now, pretty good, as well as the percentage of book current. I'm not going to explain that right now, but that's just really poor, and that's just a metric that is not really to my liking. Now, it's a very complicated matrix, so I'm not going to explain right now. And actually, we don't even see the ROE, the returns chart, because of this huge minus 3,000 chart pillar. But I do believe that their returns are pretty great. Yeah. So they have just great returns. And actually, I'm going to value this company as well, because I think that this one will also have a pretty great buy price, or a buy price pretty close to where it's at right now. So I think that's okay. The the free cash flow and profit margins are good as well. I'm just gonna go with a little bit lower here, as well as here, because they do have a really low P. And these are prices, so you can see that it's pretty close. I would probably consider buying it for like 45. So a company to definitely take a look out for. Now another company here is this education company. I also love this company. However, it's been on a very weird trend recently, or in the last 10 years. You can see that their revenue is just on well, it's decreased from 1 billion to just 700 million in the last 10 years, which is not great. So the growth is definitely not there. However, the P ratio is 8, and the price to sales is just over 1. So that's great. You can see that they actually just have no debt. And if we take the market cap of 1.12 billion, you can see that their cash is just half of that. So if you buy this entire company and just use all their cash, you would basically buy this company for about 500 million. So that's great. And you can see that their assets and liabilities also correspond with that. Now they're not doing anything with their shares outstanding, and I do believe that their returns are also pretty sweet. So that's great. Now this company I already have. I would consider buying this company around 12. So that's the thing that that's the price that I will buy this company at. Now, the next company I have here is Tiro. I've been looking at this company for a long time as well. It's just been too expensive for me, but right now it's at 100, which is starting to get really good. I'm not gonna do too much of analysis. I mean, they're buying back shares, no debt, great returns. Their dividend is very high, so they do pay. But mostly what I want to do is just calculate the fair price for this. And I think that the metrics here are pretty decent, the auto-generated ones at least. So I'm just going to go a little bit higher on the low end here and a little bit lower right here. But it should be pretty much good from there. And yeah, you can see that if you would buy this company right now, you'd get if the middle metrics were true, or were the metrics that would apply in the future, you would get a 10% return, which is not too bad. I would usually aim for a 12.5% return, so that's pretty good. So another company that I want to take a look at is actually Westlake. This is also a pretty good company. Their financials are really good. It is I believe it's a Chinese company, however... Oh no, it's a company from the United States. Okay, that's good. That means they have to follow the report standards of the U.S. That's great, because some Chinese companies may have fraud reports, so that's why it's a little bit more risky to invest in them. Most of them should have them correct, like the big companies, like definitely Alibaba has most of the metrics correct, but there might be some frauds. So, but anyway, so this company really had a decline in the COVID years, right? But then quickly came back up again. Now, into the future, the analysts are actually expecting a very rapid return to the lower metrics of 2017, 2018. But however, the P right now is 12, so not bad, and the price to sales is 1.15. Now, the profit margins of these guys aren't too good, but they're okay. They're 14% recently, so that's amazing. However, their profit margins will go down to 9, according to the analysts. Now, they haven't been doing anything with their shares outstanding, and they do have a surplus of assets, so that's great. So if the market capitalization is 15 billion, actually it's right here, their book value right now is 10 billion, so pretty good, actually great value there. Now, they have a little bit of debt, but it's no problem. They can pay it off in 2.5 years, so that's great. Their returns are, let's actually see. So their returns are they're okay. I mean, they're not anything extraordinary, especially the return on equity, but they're okay. And they do pay a small dividend of 1.3%. And since their payout ratio is, or their PE is so low, or 12, it's not too low. However, their payout ratio is only 7.5%, so that's great. Now, actually, why is the dividend yield? Okay, anyways, so this company is definitely a little bit overvalued right now. Not because, I mean, the PE is 12. However, if they're going to fall by half, I do think that it's a little bit overvalued. But a pretty good company, definitely, to put in your watch list at least. I mean, the book value is very close to the market cap. Again, the book value is basically the value of the company after selling all of its assets and paying all of the debts. Now, I want to quickly take a look at two companies that I think are great buys. right now, or very close to them, and one of them is PayPal. Now, I have done an analysis on PayPal very recently, and the metrics actually surprised me. And then right there, I had a very well, I just basically had a pretty bad opinion on PayPal. I think I was a little bit biased, but I actually think PayPal is a pretty good buy, especially because right now the earnings are very low compared to like 2021. And then in the future, they're actually expected to grow like crazy from like 2.2 to 6 billion. Another thing I love about this company is their huge moat. Like, nobody can just, you know, um, nobody can basically just enter this market that easily. And then again, they own all of these companies, like or like sub branches of PayPal, like Venmo. Everybody uses that right now, and like Hyperwallet and stuff. So they do have a great moat, and even their profit margin is great. Well, not right now, but in the past it was great, and it's forecasted to be great. They basically have no debt, or actually have more cash than debt, and their market cap is also pretty low compared to their assets. So actually, the market cap went down a lot. So if we go to the chart, this is what I was talking about. So I did analysis of PayPal at around 65 right here, and I said that I might buy this company if it goes below 60. And someone in my comments was like, it's never gonna go below 60, and here it is below 60. So yeah, it's here, and I think it's a pretty good buy right now. I think it has a lot of potential. Now, the price to earnings ratio is 16. However, that's just because the profit went so low. So if we, I just want to go conservative on the growth, because I don't think PayPal is gonna grow that much. Because even though PayPal has such a great moat, I don't think it has that much potential for growing. Now, these are okay. I think like maybe that's the right metrics to put in there. Now, these P and price free cash flows are just insanely high here, so I don't think that I'm gonna stick with that. I'm gonna go with 20, 25, and 30, 20, 25, and 30. I'm doing this because it has been really high in the past. Now, actually, I do think that these are a little bit too low. I'm gonna go with a little bit higher of a margin here. I'm gonna go with 12, 15, 18, and 14, 17, 20. And you can see that PayPal is really close to being really fairly valued, even at the low scenario. So even if it only grew by 5% and the profit margin was like 15, and the free cash flow margin was 17, they would be a pretty good buy. However, I will buy this company at 50. That's my buy price. I said that in the last video, and I still believe that that's my buy price. So it has to drop by like 10% still, and after it goes to like 52, I might consider it. Now, another company that I actually bought really recently, 3M. I think that this is just such a good opportunity right now. Even if I go with like the worst growth rate possible, like I can go -1, 2, and 5. So the profit margin, I don't know why it's 11 here. Let's go with 13 for both of these. Their free cash flow and profit margins are very similar, so that's great. Now, I'm just gonna go with the same ones there. The PE, let's go with 13, 15, 17, and same here actually. And then you can see that this company is really stable. It's at 93 right now, and the low prices are at 81. You'd make $11, and that's with these growth rates. That is if 3M had lower margins than before, you would only sell it for a PE of 15, and it would only grow by 2%. You would still get a 11% return So I just think that that's great. Even because this company is just such a stable company, so that's great. Even throughout the like, even though it's a blue chip and everything as well, it still poses such a good opportunity for a buy, I think. Now, actually, the growth rates haven't been amazing, but anyway, I think it's a good buy. Now that's it for the for this video, guys. I hope you enjoyed, and I don't know why the P is negative. There are some bugs in this platform, so if you find any, make sure to. Oh yeah, the P is negative because of the huge lawsuit. Expect their earnings to be negative as well, because this is the current P, and in their last quarter, they've actually reported a 5 billion loss, I believe. That's just because of the lawsuit, but actually the lawsuit ended up really well, so they're only gonna gain like 5 billion in debt, which means that they'll be able to pay off their debt in like 4 years. And with their cash, they're gonna be able to pay down with 3 years, and with this great returns, they're gonna be able to pay it down in no time. So that's great. I believe that this company is going somewhere, definitely. Now, that's it for this video. I hope you enjoyed. Make sure to go to this platform, check it out, and yeah, I'll just see you next time.